Let's begin with the market and these record closing highs for the Dow and the S&P 500. Let's bring in Kevin Mahn of Hennion and Walsh. Kevin, good to see you. Wow, I mean, S&P now up like 24% year to date. If your investment horizon is, say, 5 years or more, can you continue buying into the S&P, given that we've had maybe some concerns about it being top-heavy, NVIDIA today a key example, for a long time now, but it's kept going higher?
If you look at over the next 1 and 2 years, the markets do have history on their sides. We'll look over the next year. The Federal Reserve has cut interest rates 20 times historically when the market was trading at or near all-time highs, as they did back in September. And in all 20 cases, the market was higher 12 months out by an average return of 14%. Then I look out over 2 years. If you look out over 2 years right now, we've done the research, and going back to 1946, there have been 12 bull markets with an average duration of 5.3 years and total return of around 177%. We're 2 years into this bull market run and about 65% in terms of the gains. So that suggests to me, John, that we may have at least another 2 years to run in this bull market if, in fact, we hit averages. Of course, this time could be different.
Now, in the near term, given how Fed-dependent the equity markets have been, is there any danger from how strong the data has been over the last week or two, given, you know, the 50 basis point cut that we just got? I wonder if there's any cutter's remorse.
Sure. Over the shorter term, the picture is a lot more foggy to me. We have uncertainty over the election. We have uncertainty about what's happening overseas militarily. We have uncertainty with what the Fed's going to do after their meeting in November and December. All that creates the potential for short-term bouts of volatility. However, I think those short-term bouts of volatility are going to be met by cash coming off the sidelines, helping to propel the markets even higher.
And I mean, Kevin, it does seem like there's a little bit of a chase happening here with maybe some investors that were caught offsides with this market rally. You've got a Dow closing above 43,000 for the first time, but volatility is still elevated. The VIX still just below 20 here. I realize the bond market's been closed because of the holiday. What is the next sort of key catalyst, especially given the fact that valuations are stretched? I mean, is it really just the focus purely on earnings now?
100%. We have to look at valuation, the PE multiple. Price is one. We've seen prices grow up dramatically since the beginning of 2023. Earnings have been pretty good. If you look at the blended earnings forecast for Q3, it's 4.1% right now. If that holds, that'll mark the 5th consecutive quarter of year-over-year gains in terms of earnings. Not knocking the cover off the ball, but good. For us to really get valuations more attractive, we need earnings to grow even more or prices come down. Most investors would prefer earnings going up than prices coming down. Fortunately, that is what's forecasted over the balance of Q4 into Q1, because now we're going to see the other non-magnificent 493 stocks start to grow their earnings, whereas leading into this rally up to this point, it's really been the Mag 7 driving earnings growth.